This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
I'm Heather Branch with financial advisor Jon Hicks, founder of J. Hagan Capital, where day in, day out, Jon and his team are helping folks all around the greater Louisville area figure out the game that is retirement planning. And so glad that you guys do it, Jon, because for so many of us, smart, hardworking, doggone it if we don't put in the effort. And yet we show up to retirement and it is more complicated than any part of the savings part.
Isn't it crazy? Who would have ever thought that saving all the money was the easy part? I mean, and it's odd, right? Because it's not easy. Mm-hmm. But having said that, when we actually get to the point where we need to retire, it's like, hold on, What are the things I need to think about?
Everything.
How much more complicated is it than me just having a biweekly paycheck, take a small amount out, put it in something and diversify? How much harder could it be? And yet every year or every time Congress convenes or every interest rate movement or every market, whatever, something else seems to be that much more complicating. And there's nothing we can do except deal with the evolution and changes.
Just filing for Social Security alone. Aren't there something like over 500 ways to file for Social Security?
At one point in time, there were over 700 different ways to file for Social Security. They changed some of the rules a little bit. But yeah, so there's still over 470-something ways to file for Social Security, and all of them have completely different math behind it.
Of course.
So, just that by itself is very daunting and complicated, very different than, hey, how much can I get from my bank CD? You go to one bank and they say 3%. You go to the next one, they say 3.25%. It's like, yes, I'll take that, please. And it's easy. It's like the value menu at McDonald's, right? Mm-hmm. But no, it doesn't work that way for retirement settings.
Doesn't. Well, as I was saying, Jon and his team, they are here to help you get some answers to your questions, help you put a simple, clear plan into place for the years ahead. As you're listening today, if you've got questions for Jon and his team, give us a call, 502-317-0840. That's going to trigger an initial 15-minute phone conversation with one of our advisors. No fee, no obligation phone call, just a space for you to ask your initial questions and then find out how we might be able to help you figure out this puzzle that is retirement. 502-317-0840. You can also find us anytime, retirementsolutionradio.com. Let's continue this conversation about the complexity of things. So Fiona Gregg, you may not know her name. She's a behind the scenes type person. She is head of investor research at Vanguard, which sounds like a very complicated job.
Yep.
And she was on the Decoding Retirement podcast, where she herself called retirement the most complex time of our lives. Here's Fiona Gregg.
There's such an opportunity to improve and simplify these financial decisions for people. This is probably the moment in their lives in which their financial lives are the most complex. The typical person in their 50s has not one, but probably 3 or more 401k accounts, plus a 1 or 2 IRAs. So this is a very financially complex moment in their lives. And can we help those who perhaps just might not know what to do at this moment?
Jon, that's you. That's the role, the opportunity to help us simplify what is, unfortunately, it's become such a complicated process for so many Americans.
I mean, think about that for a minute. I remember when I first heard this podcast, I think last week or whenever it was that you sent it to me in the first place. That is one of the most interesting things. So the head of research at Vanguard, for investors says, this is the most complicated time. This is the most complex time of our entire lives. And when someone says that, I mean, this should make almost everyone kind of sit up and pay a little bit of attention. It's like, what was that? What was it she said? And here's the thing. I get it. It's almost like a huge reality check. And here's some of the things that I thought was interesting when Vanguard tracked all these things. Yeah. So here's a little bit about some of the research that she was talking about. So Vanguard tracked 70,000 people for 5 years after they left their 401k plans when they retired. Now, here's the craziest thing. And this is what makes everyone should just kind of pay attention for 1 second. Of 70,000 people using Vanguard, which to me says these are obviously fairly smart people. Because, Vanguard is an exceptionally good, a well-run company formed by Jack Bogle, who I think was one of the pioneers of the industry. He let everyone know, yes, everybody can have a quality investment structure. You don't have to pay these geniuses on Wall Street. But out of the 70,000 people that Vanguard looked at, check this out, nearly half of the retirees took irregular, seemingly random withdrawals.
Yikes.
Now, nearly half of the 70,000 people.
Ooh.
Now, here's another thing. 27% of those people didn't touch their savings at all. They were basically living like paupers, despite the fact that they had saved, many of them, a tremendous amount of money. They took no money at all. Why on earth, if you saved all that money, would you not utilize it correctly? So what you're looking at is you're looking at nearly 77% of people either took random withdrawals that made absolutely no sense, or they didn't touch it at all. Why? When they were polled? Because they were fearful that they would run out. Guys, those are horrible ways to go through retirement. And then 23%. Now here's the one I thought was really interesting.
Okay.
23% cashed out entirely within the first year. Now, guys, those are horrible.
This all sounds
statistics.
like no.
Aren't those bad?
Of everything you have ever talked about here on this radio program, week in, week out, John, my initial reaction to all of that is no.
It's the truth. So when you think about this, these are not financially illiterate people that we're talking about right now. These are people that have successfully accumulated significant wealth over the decades. But what happened is they had decision paralysis, all because of the complexity that we're dealing with. So if you think about it, when you're going through your working years, the rules are pretty straightforward. I mean, you just save more, diversify, and stay the course, right? The retirement is completely different. We got to juggle longevity risk, sequence of return risk, which we're going to talk about here in a second, healthcare uncertainty, tax optimization or tax mitigation techniques across all kinds of different account types, Social Security issues, estate planning, all trying at the same time to stay healthy enough so that we can actually have a good retirement. Guys, that is crazy when you think about that, right? So one of the things that I want everyone to hear right now, this is a very important topic to me and in my world, sequence of return risk. We're going to focus on that one here for a second because the markets are at unprecedented highs, which is not a bad thing. In order to establish a new market high, you have to eclipse the last one. That makes total sense. But the issue is, guys, the issue is that if we start off, and this was a Fidelity study that I come back to all the time, the Fidelity study, if you have a loss in the first 3 years of retirement, especially in that first year, your chances of running out of money or have a crippling retirement increase 600%, sixfold, 6 times more likely to run out of money or have a bad retirement if you have a negative year in the first year or 2 or 3 of retirement. Guys, right now with all-time market highs, when we're looking at these numbers, this is the second most expensive the stock market has ever been. The second most expensive. The only time that the stock market was more expensive than right now today was in 1999 at the very tail end of the dot-com boom. And we all know what happened at the very tail end of the dot-com boom. It did a dot-com bust. And over the course of 3 years, the market went down over 50%, but that's not the big one. The big one was if you were invested in the NASDAQ, which was all the technology companies, all the highfalutin companies everyone wanted, it went down 85%. From peak to trough. So you thought you were a genius. You had $500,000 in the market at the beginning of 2000. Unfortunately, by March, it had started going down. And at the end of all that, your $500,000 would be worth about $76,000. That's if you didn't do something dumb and jump off the roller coaster if you stayed in. And it would have come back. Heather, it would have come back. But it would have taken you all the way until 2017. Nearly 15 years after you got punched in the face. It took 15 years to get back to even. So if you were thinking about retirement at that point in time, is that devastating to basically have half or only a third left of your savings? Yes, unfortunately, that's horrible. So that's why I'm saying, that's why I'm letting everyone know. Do I think the market is going to fall tomorrow? I have no idea. Realistically, I think the administration's doing several things that are going to be positive for markets. But when you look at it, is it expensive? Very much so. So when you look at that as a complexity structure, that in and of itself is a reason that people should consider getting a second opinion from a skilled fiduciary advisor. For real. This is not a joke. I'm not saying this just because I'm in the industry. Most people, if they're smart savers, it doesn't require an advisor to accumulate the money. It really doesn't. You just do exactly what I mentioned earlier. You put your paycheck away and you save that money and you diversify it and you stick with that plan and you just keep on. But when it comes to retirement, if you're 3 to 5 years from retirement and you really are thinking that you have to use some of that money to live off of, guys, this is a great opportunity to get a second opinion. No joke, because the sequence of returns nightmare, that whole idea is that you can't control what the market's going to do. No one can. I can't. You can't. Vanguard can't. No one can.
Right.
But can we control when we retire? Maybe. But one thing that we can help is make sure that the money we need to live off of to create income for us, we can make sure that that is set aside, that we can't lose. And think about it. Interest rates have started coming down a little bit now, but they're still relatively high. There are really great investments out there that are less volatile, less risky, where we can get 4, 5, 6, maybe even 7% with lower risk and not nearly as much market movement. Those are attractive for an income portion of your portfolio. So why am I saying this? Well, because some of the other issues that make it complex. Social Security, guys. Social Security, it's already, and my attorneys have told me, hey, John, when they published that thing on SSA.gov, which is the Social Security Administration.gov, it literally meant that they have given you written notice that in the event that Congress doesn't do some changes, we're all going to see a 20 to potentially 30% reduction in our Social Security streams, guys. Talk about complicated. He's like, most people are like, oh my gosh, I can't wait to turn on Social Security, or I need that money. Well, what if we got 20 to 30% less? So is that complicated? Yeah. And as an advisor, what am I doing every single day? I'm looking at people going, can they handle a 20 to 30% reduction of their Social Security? Well, they can if they do this type of strategy, or if we do some of these income gap structures, or if we look at other forms of income, or should they have a bed and breakfast? Should they sell stuff on Etsy? Should they do Airbnbs? What should they do? How can they get a different income stream to replace that? That's what we have to focus on, right? And I want them to be aware of it. Hey, if the markets don't cooperate and interest rates start going down again, we want to make sure we're putting ourselves in the right position. And that has nothing to do with taxes, right? So the complexity is real. The timing element is real. And unfortunately, it's kind of like right now, Heather. I mean, that's the part that I don't want it to sound like I'm even poking fun, but I am very happy that I've got about 15 to 20 years before I'm going to retire, because I get a little nervous. Can we plan our way correctly to avoid or completely eliminate some of those problems? Absolutely. But we have to make sure that we're educated enough, we're getting the right information, we're asking ourselves the right questions so that we can lay out the framework to succeed, even not if, but when those things happen.
Jon and his team at J. Hagan Capital, they are here to help you go through these things in regard to your own savings plan. And as Jon was pointing out, if you're 3 to 5 years from retirement, now is the time. Seize the opportunity to get a second opinion of your retirement savings and investments. At J. Hagan Capital, they can do it for you. The number to dial right now is 502-317-0840. Give us a call at 502-317-0840. We've got a teammate standing by, help you to schedule your initial 15-minute phone conversation with one of our advisors. This is a no-fee, no-obligation initial step for you to ask some of your questions, and then one of our advisors are going to explain to you how might be able to help you figure out answers to these questions, understand what your risk levels are. It all begins with this initial 15-minute phone conversation, and then get to work on helping you get a second opinion of your savings and investments. That second opinion that Jon believes right now it's such a critical time to have done if you're getting close to your retirement goal line. 502-317-0840. Let's start the conversation and put a time on the calendar. 502-317-0840. You can also go to retirementsolutionradio.com or call right now. 502-317-0840. Changes are coming. 2 specifically that I want to ask you about today, sir, in regards to our 401k plans and new rules that can and will be applied in 2026.
Absolutely.
That's it. We want to go through these 2 new rules. The first one about our investment opportunities within our 401ks. So beginning next year, you, dear listener, the common 401k investor, you're going to have access to alternative investments.
Ooh.
So portfolio manager Jason Katz was telling Fox Business that this new rule comes with a warning. So here's Jason Katz.
Think hedge funds, think private equity, think private credit. Now, this is great to the extent that it's further diversification. You don't need a good stock market for some of those investments to work out, but there's the other side of that. These are opaque. They're not as liquid, the fees are higher, and you're going to have a huge universe of these new funds chasing a finite universe of private investments. So this should be a portion of your assets. It will help mitigate the volatility of your returns, but don't get over your skis. 10 or 20% at most in these alternative investments.
So here's my question. I guess it has to depend on your 401k provider and plan if you're actually going to have these alternative investment opportunities, right?
I think that's true. So right now, less than 4% of 401ks out there have any kind of alternatives involved in them at all, right?
Okay. Yeah.
And so one of the things the administration's doing, the Trump administration, they want to have more access to these private markets. And let's do a reality check real quick. Mm-hmm. If you look at public companies, and since 1990, public companies have shrunk from 8,000 down to 4,500. And all of the real money is, think about like Shark Tank, right? All of the real money that people are making, they talk like they're making money hand over fist, has all been in private markets. And so having access to alternatives can open up private credit, private equity, real estate types of development type opportunities, cryptocurrencies, different type of precious metals, different type of international markets that do the same thing, technology funds that have primarily been unavailable. So the whole thing is, and Katz, I like the fact that he kind of gave a disclaimer.
Okay.
But if you look at how the wealthiest family offices on the planet, how they manage their money, 40 to 45% of family offices, which are the richest people out there, they put their money in private stuff. They put their money in alternatives. Nearly half when you look at that. So I think that alternatives are great. But
if you know what you're doing,
there's where I was going to go. But they are complicated, right? They are complicated. Now, one of the good things, at least from what we've heard, at least from the information that I've seen and had access to, most of the types of access that we're going to have is going to come through like target date funds or asset classification funds. You're not, at least in the beginning, you're not going to be able to invest specifically in an alternative fund, not by itself. You won't have the opportunity to do that. But you may have, your target date fund may have a 3% allocation or a 5% allocation to alternatives. What would that be like? Alternative energy sources, a cryptocurrency, maybe Bitcoin or Ethereum or whatever, take your pick. I still don't know what I feel about those things historically, but they're going to have those opportunities. Okay. So if you look at it, why I think it's great is that if you look at economic growth around the world, the majority of it's happening in private companies, not public companies. Okay. So it's a great democratization, if you will, of allowing us lay people, little guys, to invest just like the billionaires, realistically. Yeah. But again, take warning, take heed. Yeah. Some of these things are complicated. And we do believe in my office, we do believe in alternative investments. I think they can be very attractive if you have a levels of sophistication, you understand, and I typically do not feel that most people should go up to 50% of their net worth in these types of things because illiquidity, it's hard to get 100% full transparency. If you look at some of the best hedge funds out there, they really don't show you what they're doing on a day-to-day basis. They really only give you a monthly or quarterly report. So if you're hyper wealthy and you know that you're going to hold that investment for a long period of time, and why would you do that? Because frankly, they've outperformed the markets by a long shot, like 2 to 4% a year better over long periods of time, which is pretty good. I mean, that can basically double your money 8 years sooner if you get those type of returns. But having said that, I don't think people should put too much of all their eggs in one basket. Sure. But I think it's great that we're going to have access to alternatives. And I like the fact that the administration's going that direction. Yeah.
Also, you were pointing out how you utilize alternative investments in some of your portfolios. And again, it's like if you know what you're doing. So with the help of a fiduciary on your side to guide you through your alternative investment options, Jon and his team, they are here to be those people, those guides with and for you as well. RetirementSolutionsShow.com is where to go to start that conversation. All right, change number 2.
Yeah.
There's another new rule taking effect next year around the super catch-up contributions to our 401ks.
Yeah.
So explain that.
Yeah. So starting up, I think it was January of next year, January of 2026.
Yeah.
You can do more catch-ups. As a matter of fact, so most people are aware when you're putting money in your 401k, when you turn 50, between 50 and 59, you can actually do a catch-up payment. You can get up to $7,500 into those accounts, which is great. Now, here's what they call the super catch-up is going to happen if you're in that sweet spot between age 60 to 63. They allow you to put up to $11,250 in those catch-up type payments
extra
in your 401k.
On top of what you already contribute. Okay.
After on top of that, which is great. Yeah. Now, I here's a little bit of a caveat. If you do well and you're a great earner and you make over 145 grand a year, all of those catch-up payments, they have to actually go to the Roth. Now, I historically like Roth accounts because it grows, hopefully, over long periods of time, and you don't pay any taxes on the way out.
Right.
But I see this as Uncle Sam doing a revenue acceleration scheme. I feel like you almost have to do one of those silly little laughs.
You have to do a laugh when you say scheme.
Yeah. So what they said is, okay, we're going to allow you to do this. And we're going to allow you to put more money away, but we're going to charge you tax dollars now.
Right.
So if you do a good job earning, you may be paying, 30 to 37% of the tax payment, not including state, in federal taxes. So this is used, in my opinion, as the government kind of accelerating some tax revenue, right? So, but the good news is that we can put more money away. And people that have done a good job saving, they typically like this opportunity, because that was one of the biggest issues. When you look at billionaires don't often have a lot of money in tax deferred accounts. Why? They couldn't get it there. Right? You can only put in X amount a year. If you have an IRA, it used to only be $2,000 a year. Then it went to $3,000. Now we can put as much as $7,500 in those types of things, or our IRAs or our 401ks. Now we can put X amount of dollars in, $19,000 a year, and then it moved up to $26,000 if you have profit sharing. But that was all that anyone could get in there.
Yeah.
So now that we can do more, there are more opportunities for us to defer some money in some of our cases, or get it into a tax-free bucket, second place. But we can save more money. I think that is great. Overall. So, everyone that I talk to says, man, I wish I had put more money away a little sooner. But since I didn't, I'm going to take advantage of these catch-up payments. So I think that's great. Now, the big thing is, though, the government is going to make some extra tax revenue off of us. If we've done a good job saving.
Okay. So then what do we need to consider in regards to the tax opportunity, or the do's and don'ts tax-wise?
Yeah. So when you kind of look at the three different places any of us can invest, there's taxable accounts, tax deferred accounts, and tax free accounts. The biggest thing to me is you want to establish those as kind of different buckets, right? So for your taxable accounts, so that's going to be like your money in your checking account, or if you own some stock, in a company that's not in an IRA or not in a 401k, you typically want those to be in things that are very tax neutral, right? We don't want to have a whole bunch. Here is the worst thing that you can do. Have a taxable account with a bunch of mutual funds in it. Or have a taxable account, you earn a lot of interest income, like CDs or bonds. Why? Because interest income is the most oppressive part of the tax code. You pay the most taxes on interest earned. So we do not want that in taxable accounts. We want our interest earning money, like our bonds or our annuities and things like that. We want those to be in a tax deferred bucket. That would be the best. Okay. So the way that we can use this to our advantage is understand our three different buckets, what we have and where. So it's really not about asset allocation. It's about asset location. Now, that tax-free bucket, like the Roth or the Roth 401k or Roth IRA, we want that to be our high-flying growth type opportunities. If we own the S&P 500 or the NASDAQ, or we may have some of these alternative funds, those would be great to have in a Roth. Why is that? Well, because when we put the money in, we hope it's going to grow a lot over the years. Maybe it doubles or triples or quadruples. We don't want to pay taxes on quadruple the amount. That'd be a ripoff to us. And yet you'd be surprised how many people I run into and their high flying stuff is all in a tax deferred account. So in that 100 grand that they got in there grows to 800 grand, they got to pay taxes on the 800 grand, Heather. That is not very tax savvy at all. So we can fix that, but we have to understand. So I think this creates a really unique opportunity, especially if you deal with a financial advisor that understands the tax game, because it is a game. 100%. It is a game. There are rules to this game. It's like chess. It's unlike checkers. So we want to know, is it strategic? Should I move rook? Should I move my knight? Should I move my queen? What about the bishop? How about the pawns? Yes, every once in a while the pawns get taken. It's okay as long as you can get to that check or checkmate point. So that is the tax game. And that is always what we're focusing on in my office at J. Hagan Capital, simply because it's a big portion of our money. And we want to make sure that we keep more of it and keep Uncle Sam at bay. That's the whole point.
Goals. Stay away, Uncle Sam. You can't have all my money.
Well, I mean, if you think about it, we got over nearly $38 trillion in national debt. That does not include not having a balanced budget. It doesn't include whatever money we're going to spend on wars, whatever money that the government is going to start investing into other companies. This is going to be a long debt cycle. And I think the government's going to need more of our money. So we have to be very savvy and smart about how we allocate it, because if the government's going to need more money, all it's going to do is one thing: knock on our door and come take it from us, right? And there is precedent, not only in European nations, but in the United States, that if the government needs more of our money, it will just start to take it. Now, they're going to have laws around it. There will be some rules, but it won't be very nice. So we want to make sure that we can be as smart as we can with the tax code we're currently given. We want to exploit it. That is not a bad word. It just means that we're using the tax code to our best favor. That's it. And if we do that correctly, we will win to fight another day and win the chess match.
And reminder, where we started this conversation talking about 401ks and changes that are coming, for the most part, I believe most of 401k money is tax deferred,
which means
across
we
America.
We have an IOU.
The government's got its eye on it. Oh, yeah. So
they have an IOU. So we have to make sure that we are doing these smart things, because later on, we know the tax rate right now. 10 years from now, it could be twice that amount. It's been higher than that historically, guys. You have to understand. You only have to go back to the 60s, where the highest marginal tax bracket was over 90%. And the lowest tax bracket was in the 30%. I think it was 32 or 36% was the lowest tax bracket. So we want to make sure that we're protecting ourselves from that possibility.
RetirementSolutionShow.com is where to go to start the conversation with Jon and his team about these 401k new rules that are coming in 2026, about how to do better with your 401k and tax options that you might have. It's different for every single person that they meet with J. Hagan Capital, so they need to meet with you to help you understand what's really going on within your savings and what your options are. So you can begin that conversation by clicking the links we got posted in the show notes, or again, just go to the website, RetirementSolutionShow.com. Let's get to work helping you with your 401k. We're on a hamster wheel, John. It's the rat race.
Always?
It's
Dude, it is.
We're like one of those little mouse maze puzzle things where the little mice are all running around the little mazes trying to find the piece of cheese. That's what it really is. I just figured it out. The analogy.
It always feels that way. It always feels that way. You got to keep up with the Joneses. You got to find the cheese, in the maze, all that stuff. It's always that way.
Somebody moves your cheese. What's the name of that book? Who Moved My Cheese?
Who Moved My Cheese?
Yeah.
I'll tell you who did. The government did. The government moves my cheese. Every year they move my cheese. They take my cheese and they put it in their pockets.
What flavor is the cheese? Is it cheddar? Is it Swiss?
Limburger. That's what I give to them.
You're all
the pungent, terrible, stinky stuff. They can have all that. Is that
the stinky blue? Got it.
Right. They can have it.
As investors, as savers looking to find ways to generate income for ourselves in retirement, it has been they keep moving the cheese, it feels, as of the last few years. So as we've seen interest rates go up, as they've done, billions of dollars, investors started putting more into CDs and money markets.
Sure.
Then as millions of boomers started to look for more income in retirement, because less and less of us have pensions, there was also a record number of annuities being sold each month.
Sure.
Now, the Wall Street Journal published an article talking about billions of dollars that are being poured into dividend-paying stocks. So let's talk about, obviously the appeal of dividend-paying stocks is the dividends that they pay.
Of course.
So
absolutely.
Let's talk about how you're using them, but also just this overall, again, this maze that we're constantly navigating our way through, an effort to find income sources, protected income sources for ourselves in our retirement.
Yeah. So, if you think about it for a quick second, when you look at 2022, that was the biggest year in a long time of people realizing bonds may not be all that great.
Yeah.
Now, I have in my office for years and years and years and years showed people that bonds, when they're used as a hedge against market volatility, can be somewhat productive. They can be decent. But when you look at bond funds, guys out there, when you look at bond funds, they've averaged like less than 2% a year for the last decade. Even the best ones, even the ones from Vanguard or Fidelity or Schwab, that is not very good. That barely beats, in some situations, CD rates and money markets and fixed annuities. Now, having said that, the reason that people did it is because that's what they were advised to do. So in our office, we've always had bond alternatives that are much more stable, much more secure. And many times we would use dividend paying stocks as a kind of a backstop, if you will. It's not risk free. We all understand that. because in any given day, and people around here are aware of this, UPS, UPS for a long time had a really good dividend. People held on to UPS stock because of that dividend. Well, if you look in the last 5 years, UPS stock is down over 50%. That is a kick in the face. So when you think about that, it's like, oh, I want a great dividend paying stock. Well, you still have to understand you can lose money in that. You could absolutely lose money. UPS has lost 50% of its value to the point where that 2.5% to 3% dividend now is almost 8%. And now they're talking about potentially cutting that dividend, right? Okay. So the biggest thing to understand is I think that dividends are great as an income producing type asset. There are other better ones, in my opinion. Oh, yeah? If you don't have a pension, annuities could be fine. You just have to understand, what is it for? Is it complicated? Does it have fees? All these things that make annuities so terrible to some people are okay for others, again, as a bond alternative. But it just really depends on what you're looking for. So one of the greatest things that have happened over the course of the last several years, in my opinion, is there are so many other income plays that can also be a volatility buffer. So some of these things are really literally called buffered ETFs, which means that they have some kind of a protection in there, right? Mm-hmm. But they don't have to use bonds. Why? Because bonds lost a fortune in 2022. Why? Because interest rates moved up. Not complicated, but it stinks. So income producing buffered funds or barrier funds can be very attractive for some people. Banks produce what they call structured notes or principal protected notes. Now, like that name suggests, as long as that bank stays in business and doesn't go under, principal protected note is guaranteed against loss by that bank, not by the FDIC often, not by the government, but by that bank. So if it's a good quality bank, those can be very attractive alternatives to bonds. Now, why are we talking about that? Because frankly, guys, I think bonds are going to continue to stink in the long run. Plus, it's also debt. When we look at how much debt we have as a country, how much corporate debt is out there in the world, I don't like the idea that if that company doesn't make its payment, you could potentially lose your principal. I don't like that. So the idea of dividend stocks or dividend paying things is really good. Another thing that's come out more recently is option premium. Now, some of these funds out there, and you have to be very careful, because some of these that are paying like 10, 11, 12% dividends, they can also lose tremendous amounts. Like, for instance, this year, between March and May, I believe there were many ETFs out there, many exchange traded funds, many investments that were producing 7, 8, 9, 10, 11% of income. But when the market got kicked in the face, they went down 25, 30, 40% for that period of time. So that could be very devastating, right? So the main thing we want to do is we want to understand, how can we diversify our income sources, right? How can we be certain that we can produce income that we can spend? That's why people love pensions. That's why people like getting that Social Security check. It's consistent. It's why people that have annuities that aren't against them, why they like that, because they're going to have an income check that comes in all the time. Now, having said that, I think dividends are better than most other options for some people, because it typically has a built-in inflationary hedge, because you're going to get that payment, hopefully that 2 or 3 or 4% income payment. But at the same time, over time, if we expect the market to rise, you should get a little bit of appreciation in that stock value, right? One of the things that people don't use anymore are preferred stocks. I think preferred stocks are great. Why? Because they're paying 4, 5, 6% right now. Good quality companies often offer these, not as many as there used to be. And the main thing is they're usually much more, they're a lot more stable than the overall stock market. So these are all things we need to consider. So, when you're thinking about developing your income plan, which everyone needs to have, at J. Hagan Capital, we ensure that everyone has a proper income plan. We don't want 1 or 2 income sources. We don't just want Social Security and then pulling money from our retirement accounts. That's a terrible plan. We want 3 to 5 completely separate income sources. So important, right? Because we've already seen the writing on the wall. Social Security may be reduced. We may not have a choice in that. There may be nothing we can do. So if our Social Security income goes down potentially 10 to 25%, we need something to offset that. And that's not me making this up. It's what we've seen written. All of the financial gurus are talking about it. Even the SSA.gov website is basically already told us in writing that unless something major changes, we can all expect less money out of Social Security. I get it. So we have to make sure we have 3 to 5 different income streams. Dividends play a huge part of it. I was looking at it the other day. One of our income dividend portfolios in our office is paying a little bit better than 5.5%, fully diversified, all high quality stuff. And there's some things that pay even more than that. You just want to make sure that you have volatility control. You want to make sure you're doing the quality companies that can hopefully withstand if we do have a recessionary environment, right? You want to make sure that they have income that's diversified. 3 big things. Chasing the yield, chasing the highest payout often is a recipe for disaster. You just want to make sure you have quality income that's going to come in. And I think a couple of weeks ago, I was even talking on the show about a dividend aristocrats. These are typically companies that have been around for a very long period of time, and they have a history of increasing their dividend rates over time. They basically say, hey, we've done well for ourselves. We're going to reward our shareholders by giving them a little bit more of our income. I think those are good. Just be careful. The higher they pay, that can be a little bit of a trap. They call a value trap. Where you can potentially, just like UPS as an example, it looks like it's paying a good dividend, but you lose 50% of your principal. So these are things to all consider when you're looking at that kind of stuff. Behavior risk is the biggest factor. We have to make sure we can handle the ups and downs, because the income could be a little bit volatile. From a dividend paying standpoint, it's not going to be as precise as a pension payment, or a banknote. We want to make sure of that. But behavior risk, this is why I feel that most people, when they're creating an income stream, need to deal with a skilled fiduciary advisor. Be certain that you're aware of all those options out there. If there's something out there that works, we want to be able to consider it, right? That's the whole idea. And many of us, because we're just not used to this, it's not our standard language. We don't know where to look for it, right?
Well, we've never had to deal with it. Our income has been our paycheck. Now we have to create these different sorts of income streams through income diversification, and the options and opportunities were ones we never even needed to consider.
That's exactly it. So most people just get a W-2. They worked for a company and they got their paycheck after the taxes came out. Now we may have to have 3 to 5 different income streams outside of Social Security. So we want to be certain that we're doing the right thing, that it can evolve as with our needs, right? And make sure that there's flexibility, because things could change. Things will change, sometimes on a week-to-week basis. So we just have to be certain that the plan that we create for ourselves, that we can stick with it. That's how we win in the long run.
John and his team, they're here to help you figure this out. 502-317-0840 is our phone number. 502-317-0840. Give us a call. Let's begin the conversation about your income plan for retirement. Do you know what your options are for income streams and diversification? Do you know how many income streams you will have in retirement? John's saying you need 3 to 5. If you don't know the answers to these questions, we can help you find out. 502-317-0840 is the number to dial right now to put a time on the calendar for an initial 15-minute phone conversation with one of our advisors. This is a no-fee, no obligation initial step, just a space where you can ask some of your questions. We'll talk to you about how we might be able to help, and also how we can begin the income planning process for your retirement. If you're 5 to 10 years from retirement, if you've saved at least $500,000, this is an opportunity to see the real power of this kind of planning in action. So give us a call, 502-317-0840 to schedule your initial no-fee 15-minute phone consultation, 502-317-0840. Your girls are 8th grade and 10th grade, 7th grade, 6th grade.
5th and sophomore in high school.
I always do that. I always try to make your youngest older than she is. It's like, shame on me. Do not make her
shame on you.
I know,
don't grow her up too fast.
How dare I? I apologize. But I was wondering, do they do anything? Because it's that time of year when there's like the school fundraisers where do they have to like sell the bags of popcorn? I used to sell Sally Foster gift wrap. Did you ever have to sell anything?
Let's see. Yes, we did World's Finest Chocolate. Often we did magazines a few times.
That was another one we did, the magazines.
Over the years, most of their stuff, they don't do that. It's kind of like just they beg for donations, or
it's up to the parents.
Walk. Yeah, they'll do the walk, or if they or a reading thing, if they read a book, they get like $1 per book, or whatever the thing is. So I mean, those things are fine, and it doesn't, I don't have a whole bunch of chocolate that I end up eating at the house. Now, my littlest is in Girl Scouts. So there are cookies. There are cookies.
And that cookie season, man, it happens right after the holidays every single year. I'm like, it's like they want me to keep these 15 extra pounds on.
Of course they do. That's how they stay in business. That's exactly
those little girls in their uniforms, they're coming for us.
But it's worth it because they're so cute. So cute. Their little, uniforms.
Now, when it comes, let's get to the magazine subscription conversation, because when it comes to the magazine subscription opportunity that used to be in the 80s, 90s, wasn't quite so adorable. But for a lot of people, it was a very exciting opportunity. The Publishers Clearinghouse. Remember the Publishers Clearinghouse? Who was it? Was it Ed McMahon? Yes.
Ed McMahon.
Showed up to your doorstep with balloons.
Darn straight. Yeah.
So if you are our age, 40 on up, you know about the Publishers Clearinghouse sweepstakes. And did you know, though, have you heard how Publishers Clearinghouse recently filed for bankruptcy?
Oh,
Well,
are
think
you
about
serious?
It's magazine publication that they base their sweepstakes on, I think, for the most part. And who has magazine subscriptions anymore? It's all online now.
Historically have always loved magazine
Same.
subscriptions, like to the point to where I would get Sports Illustrated, not just for the swimsuit issue, no, realistically, because it came every week, right?
Yeah.
So every week I had something in the mail that belonged to me.
It was fun.
And even if
like a little
even if
present.
it was all about like hockey and crap that I could care less about, I would still go through it because I love getting that, right?
Yep,
and then
same.
I had all the other subscriptions because there was just something magical about getting that, that guitar magazine or that take your pick on whatever it was. It was awesome.
It's all online
and yet now I don't think I have a single magazine subscription because I can go onto Pinterest or Instagram or anywhere and Google whatever I want,
TikTok,
and immediately get that information.
It's sad.
I know. It is sad.
So we're not the only ones that are sad. The winners of the Publishers Clearinghouse sweepstakes are also very sad. In particular, talking about there was a particular prize, a jackpot called a $5,000 a week for life jackpot.
That sounds like so much money.
So good. And the winners of that are now out of luck because there's a new parent company, ARB Interactive, and they are saying, we're not going to continue those payments. Like, this company went out of business. We're not following that suit. This is John Wiley. He is one of the $5,000 a week winners, and what he was saying about the bankruptcy issue.
Why didn't somebody at least give me a heads up? Hey, we're going out of business, No, it's like somebody just cut the cord. I'm pretty sure I'm going to lose my home. Sold my jet ski, sold my trailer. I had a little bit of money left over, and that's what I'm living on right now. I was proud of the fact that I left my children something. Now I can't leave them anything, and I'm really disappointed.
Wow.
Here's the thing. This guy, not you, Jon Hicks, this gentleman, John Wiley, he won his prize in 2012. So if you do the quick math, after the checks stopped coming in, he had already collected over $3 million, John.
That's
and
right.
do we think he ever sought the advice of a financial advisor?
73% of human beings do not use a financial advisor. 73%. Now, here's the thing, and here's how I know he did not use a financial advisor.
Okay.
He basically, this is almost like a masterclass of financial planning failures. 100%. It doesn't necessarily even break my heart. It's these stories that hopefully will stick with people and they realize, John always says, and of course he's in the industry, he's trying to earn our business, but at the same time, it's like, it does make some sense when you think about it. This is why the greatest golfers have coaches. This is why the greatest basketball players have coaches.
Celine Dion has a voice coach. Mm-hmm.
Specific trainers, specific coaches, because at different varying levels of talent, or in this case, finances, it requires different thought processes. John thought that he was going to get $5,000 a week every week for his whole life. So let's do the math real quick. That's $260,000 a year. For over 13 years, this guy collected over $3.1 million. He already has to sell potentially his house, and he already got rid of his jet ski, and he has no money in the bank other than a little bit that he has. Guys, if you had $3 million that you had coming into you, wouldn't you have saved a little bit of it?
If you earned $260,000 a year in income, wouldn't you have saved some of it?
Absolutely. And this is why I think it is an absolute masterclass of failure. He violated nearly every basic principle of sound financial planning. He spent 100% of the money, obviously, on things he didn't need if the only things he has left to sell is his home. Think about it. That means he has no other actual assets that have any value. You already sold the jet ski.
Right.
So when you think about this, he built his entire retirement, if you will, around one singular income stream from one singular company. That violates in its own very nature everything that I stand for. You know, like, what do we say all the time? 3 to 5 different income streams.
Yep.
Do not only rely on Social Security. Expect it could be cut. Expect the government to take more taxes from all of us. And this is not just doomsaying. This is the truth. I have seen it happen. I've seen good companies like UPS that were great for a long time, paid really good dividends, and their stock is cut in half. General Electric, which was a great company, but unfortunately their stock is worse than cut in half over the years. I've seen the markets crash. I've seen interest rates go down. I've seen interest rates go up. I've seen inflation, crazy things. This guy did it all completely wrong. So here's the craziest thing. When you look at Publishers Clearinghouse, they filed for bankruptcy. Now, here's what they put in their actual bankruptcy proceedings.
Yeah.
They said that they have liabilities between $50 to $100 million. Basically, they owe people between $50 to $100 million, and they only had $1 to $10 million in assets.
Yikes. Well,
That is crazy. So here's the thing. Any financial advisor worth their salt at all would have told this guy to save at least 30 to 50% of that income coming in.
Yep.
No question.
Yep.
No question. Because if you just think about that 30 to 50%, the guy would have saved $1.5 to $2 million, even if he just had it in money market over the past 13 years. There would be no way that he should probably have to go back to work. But now the guy finds himself, he's in his 60s. Now he's in his 60s, has no assets to speak of. He's going to lose his house all because a company went out of business.
yeah.
And it happens all the time.
Yeah.
When you look at it, there were 8,000 publicly traded companies in the United States in 1990, and now there's less than half that many. So what happened? Well, some of them got bought out by others merged or acquired other things, and or they went out of business. If you actually go back 100 years, 98% of all businesses that were around 100 years ago are no longer in business. Less than 1% of all the companies that are around today were around 100 years ago because they failed.
Yep.
Right?
Yep.
Buggy whip manufacturers, all those kinds of things, those go out of vogue. So we have to understand, what can we learn from this? We have to, if we want to have a solvent and sound retirement, we have to do 5 pillars. They all have to be done correctly, right? Or we could potentially fail. Number 1, you have to have protection of your assets. This guy obviously didn't protect any of his assets. He didn't even save any of the money. If you don't protect your money and the market goes down or interest rates change, or in this example, something goes out of business, like your pension is no longer available to keep paying you. I know that can happen because my wife was a flight attendant in the airlines for over a decade. She actually would have been given a pension, except for U.S. Air went out of business. And American Airlines ended up buying them out. She lost what would have been, it wasn't huge because she wasn't with them forever. She lost about $19,000 a year of what would have been a guaranteed pension in retirement. Now, I think the last paperwork we saw, she was getting like $68 a month. Right.
Okay.
And that's assuming, right.
Tank of gas.
barely, not in the gas guzzlers that we drive.
Right.
So when you look at that, we have to understand, we have to protect, number 1. Number 2, income is the second most important thing. After you have protection, because if you have $1 million and you lose half of it, you guys, you're not a millionaire anymore. You've only got $500,000, but you have to have protection so you can create income. And I've said it so many times, I'm going to keep saying it till I'm blue in the face or till I'm off this planet. 3 to 5 income streams in retirement is absolutely mandatory because you never know when something is going to go wrong. This guy had no other income sources. It appears he had no other ones. One company was paying his bills. So income is number 2. Number 3, we have to be tax savvy. We have to understand it's great to have an income, but if the government taxes 70 to 80% of it and we don't get to spend it, then we may not be able to stay retired, right? So that's number 3. Number 4, wealth transfer. The guy said he thought he was going to have all this money to give to his kids. Now they're going to get nothing. Hopefully he doesn't have to go move in with one of them because that's insult to injury, right? You know, that would be even worse. But I see it happen all the time. People are not planning for that. So that number 4 piece is wealth transfer. How can we make sure that this money that I have transfers without it going to the government and actually can support a surviving spouse or kids or grandkids or whatever you want? And the 5th one, we have to make sure we're taking care of and thinking about healthcare needs, right? I do not personally love long-term care insurance. I think it's very expensive and most of us don't really require it if we've saved well, but we have to be cognizant. 70+% of us are going to have some type of long-term care. So we want to make sure we have the asset utilized to pay for that. Whether it's a Roth account, if we didn't end up spending it for income or whatever it is, we have to make sure we do it. Those 5 things, equate to a solid retirement. The guy did none of those. So the fact that he's unfortunately having to pay the ultimate price for that, the best thing that can happen is we can learn from that, right?
Yeah.
We can learn from that. Your pension could be unfortunately frozen, liquidated, not offered to pay by the next company. That happens. Pennies on the dollar for some people. Social Security, we've already seen the writing on the wall. It could be reduced. The market could go down. Interest rates could drop.
Yep.
Payments can stop. The big thing that I've heard recently about UPS is they may cut their dividend. Not to zero maybe, but they may cut their dividend. That can happen. So we have to be prepared for that. It's a great opportunity, if you haven't worked with a quality, skilled fiduciary advisor, to consider, what do they think? What is their philosophy? Can they help you navigate all those issues? If they can, just listen. Doesn't mean you have to work with them. But the idea is that a second opinion may be your first real opportunity to make really great decisions.
Jon and his team, they are here to help you in that second opinion process. What layers of security do you have around your savings for retirement? Let's sit down and go through that together with you. 502-317-0840 is our phone number. Give us a call right now. 502-317-0840. That's going to trigger an initial 15-minute phone conversation. This is a no fee, no obligation initial conversation, just a space for you to ask some questions, and then our advisor will explain to you how we might be able to help you figure it out in a plan of your own, one that's customized to you and your goals. And again, it begins with this 15-minute phone conversation with one of our advisors. 502-317-0840 is the number to dial to schedule that time on the calendar. You can also go to retirementsolutionradio.com or give us a call at 502-317-0840.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with Jon and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to Jon's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 1882794.